All right. It is 10:05. Can the folks online, can you hear us okay? Thumbs up if you can. Okay, great.
Yes, we can.
All right. So we're going to call the commission to study stable tokens, real world asset tokenization, and blockchain-based trust. It's a very long name. Call the meeting to order. If you want to follow along, the agenda is online, nhtokencommission.org, and you can find a page for today's meeting. I do have one change to the agenda. We had BitGo kind of in the hopper to present, but they had their initial public offering yesterday, so they're in their quiet period. So we're going to postpone them, I think, until March. And in their stead, we have a project called Ceres Coin, which is an SEC registered stable token. And I think we have them online. The Ceres folks, could you just say hi and make sure that we have you?
I'm here.
Okay, great.
Charlie, which is here.
All right, Charlie, we'll have you go after Anchorage. So before we do that, let's see if we have a quorum. And I think we need, I forgot how many we need now. I think it's 7, but we have 5 of us. Any commission members online? Do we have Chris McAleer, Andy Schwab? Katie's there. Hi, Katie. We have 7. Oh, see Andy. Okay. All right, great. So the first order of business, are there any changes to the agenda for today? All right. So without objection, we'll consider the agenda approved. And then we have the approval of the December 12th meeting minutes. That is online on the page. Are there any changes to the agenda? Any discussion on, not the agenda, I'm sorry, the minutes from December? And basically that's an AI generated from the transcript with a few spelling corrections. So that's how we're doing that. All right, so can we have a motion to approve the December minutes?
So moved.
Okay, thank you, Jim. Second?
Second.
Second. So all in favor of approving the December minutes? Aye.
Aye.
And any opposed? No. All right, so the minutes are approved. So we'll go right into the presentation from Anchorage. And we have Melinda here from Anchorage. You came all the way from the state of New York. Yeah, you came on a good day. The birds are singing and the squirrels are playing. Yeah, that's right. So turn your mic on. The red light means it's on.
Okay.
And then just state your name for the record. And
Melinda Dellis
okay.
from Anchorage Digital.
All right. So Melinda, do you have are you on the teams?
I am not on the teams, should I? And I don't have the...
So I have it up here. So I'll run the slides for you if you just want to say next slide. Does that sound all right?
Perfect. Yeah.
All right.
And we do have one change up to the team members. So, but I think
okay, we
don't need to delay that.
Just give me 1 second to fiddle my way here to sharing. All right. Screen. And where did it go?
Would you prefer the updated version of the
I
I sent it to you, or just it's easier to just
it's
use
easier
this
just to go with this. You
Let's
can
do it.
yeah.
Mm-hmm.
All right. And then we can present somehow, right? Everything is in the way this morning. All right. How do you go full screen in Acrobat?
Ooh. If you needed in another format,
They are, yeah.
I thought I was making your life easier, but I can export it in another format pretty quickly. So.
Oh no, I think my license for Adobe is giving me trouble here. there's a way to make this full screen, but it's not working.
How about I'll export it to, does PowerPoint work for you, or do you prefer Google?
I think this is fine.
That's fine?
Yeah.
Okay. Our slides don't have too much small text.
Should be F11, right?
Yeah.
There it goes. All right.
Great.
Yeah, if you just say next slide, we'll go.
I'll do that. Yeah.
Hey,
Perfect.
Senator Abbas. I know. Welcome.
Um,
You can sit here.
perfect.
All right, take
Get
it away.
started.
Sorry for the rough start.
No worries, no worries. Well, Representative Ammon, members of the commission, thank you very much for the opportunity to be here today. Stable tokens are really a central piece of the work that we're doing at Anchorage Digital, and we strongly believe in the potential benefits for both the state of New Hampshire and the country at large. And so this is something we're very excited to speak to you about, and we're grateful for the opportunity to contribute to the work of this commission. Our goal here is not to advocate for a particular outcome, but to be a resource to you as you evaluate the types of opportunities that this technology presents and the kinds of guardrails that are available to help shape it in a way that is best for your constituents. So let me start by outlining what we plan to cover today. Representative Ammon, if you might shift to the next slide. Perfect. So after introducing our team briefly and just a brief overview of Anchorage Digital, we wanted to discuss the kind of momentum that we are seeing after the Genius Act. And I know in previous presentations, you've covered a lot of the regulatory side and the Genius Act. So we wanted to focus more on the activity post. But we do have our head of policy, Kevin Wasaki, on the line. So if we have any questions on the regulatory front, we can go back to that in Q&A. And then we are going to talk then about how banking is changing in response to this technology. And Joe will be handling that piece, who heads up our financial institutions group. Oh, no.
Let's just do a sound check here.
Sound
folks-
check. Can you hear me?
Folks online?
There we go. Wonderful. So let's go back to the beginning. I'll do a brief, or did you catch the beginning of this, or should we redo the beginning? I'll do a brief recap then, or is that probably best for the record, right? Okay, well, Representative Ammon, members of the commission, thank you very much for the opportunity to be here. Stable tokens are a central piece of the central focus for us at Anchorage Digital, and a big part of the work that we're doing right now. And we strongly believe in the potential benefits that this technology offers for both the state of New Hampshire and for the country at large. We're very grateful for the chance to contribute to this process and to share our perspective on this fast-moving and truly transformative financial infrastructure. Our goal here is not to advocate for any particular outcome, but to be a resource to you all as you evaluate how this infrastructure can work in practice, the opportunities that it creates, and the kinds of guardrails that are available in order to help shape it in a way that's best for your constituents. So I will begin by outlining what we plan to cover today. Representative Ammon, if you wouldn't mind switching to the next slide. Perfect. So we'll start off with a brief introduction to the team that's presenting. There's myself here in person, and I have 3 colleagues that are on the line with us as well. And we'll give you an overview of Anchorage Digital as a platform and what we do. Next we'll shift to what activity we have seen post the adoption of the Genius Act. I know in previous sessions, we've actually you've covered a lot of the regulatory side of things, so we didn't want to be repetitive there. But our head of policy, Kevin Wasaki, is on the line in case there are any elements that we would like to dive into further in Q&A. Then we'll shift to how banking is changing in this new technology, and we have Joe Medioli, who is the head of our financial institutions group and works very closely with all types of banks and other financial institutions. So we'll dive into that. Then specifically opportunities for New Hampshire, what we see and have a discussion around that, plus responsible innovation, which is very much at the core of our approach as Anchorage Digital, is how can we move forward and be leaders and innovate while still protecting consumers and meeting the requirements of compliance and regulation. So that's an overview there. If you wouldn't mind switching to the next slide. So I'll first introduce myself and then allow those on the line to introduce themselves as well. We are missing one person, unfortunately, Kevin Wasaki, who is on the line. So I'll have him introduce himself as well. But for background, so my name is Melinda Dellis. I lead institutional partnerships and strategy here at Anchorage Digital. I work very closely with our qualified custody business and engaging with clients that are in more emerging segments that are newer to the digital asset industry. I've been at Anchorage for just under a year, and I've been in crypto for a little bit over 5 years. So have seen both the centralized and more decentralized and tech-heavy sides of this industry. And prior to joining crypto, I spent 13 years at Morgan Stanley, majority of that time in derivatives roles, so have a structuring background, which very much shapes the way I think about products in and how they can be customized and suited to clients, and that very much shapes the way I view the digital asset industry. And I also did strategy and analytics for the institutional equity division, so working a lot with hedge funds, asset managers, pensions, endowments, the more institutional side. So that is my background, and I will pass it off to, I see Joe there. Joe, would you like to introduce yourself?
Absolutely. Members of the commission, thank you for having us today. My name is Joe Medioli. I had intended to be there in person, but young children and flu being what they are, still happy to be here, albeit remotely. As Melinda mentioned, I head the Financial Institutions Group here at Anchorage. FIG, as we like to call it, is our business quite specifically focused on providing solutions, services to the traditional side of this space that is beginning to and really accelerating their exposure to both the technology and the asset class that is digital. We focus on banks, large FIs, asset managers, and wealth managers, and we'll touch on a bit of each of those topics a bit later on this morning. I've been with Anchorage coming up on 4 years in various roles, but all really focused on this concept of supporting a traditional institutional adoption of the asset class. I've been in the sort of crypto space writ large for about 7 or 8 years at this point. Spent the prior large track of my career in the regulatory advisory and management consulting space. Actually helped advise quite a few digital asset firms prior to my time at Anchorage on their licensing programs, as well as working with other states on thinking through their own supervisory regimes, examination regimes as it pertains to digital assets. Very excited to be here today. I will hand it over to Kevin Wasaki.
Hi everyone, this is Kevin Wasaki. I'm the head of policy at Anchorage. I've been here about 3.5 years. Previously, I worked on Capitol Hill for a little over 7 years, focused on financial services policy there. Most recently, I've been working a lot on the Genius Act and now market structure at the federal level, but also following closely some bills at the state level, dealing with strategic crypto reserves and other matters. It's nice to meet all of you. Tom, do you want to go next?
Tom, are you on? Yeah, I don't think Tom was able to make it. he's had a family emergency. So I'll briefly introduce Tom. Tom is actually our head of government solutions. So I work very closely and partner with Tom as it relates to states in particular, but Tom is overseeing the entire effort. He works very closely on the federal side with different government agencies, and he has an extensive intelligence background and work with the government that he brings to the table. So at Anchorage, the way that we're approaching helping governments is very much, again, an interdisciplinary approach. We have folks like Joe Medioli and myself that bring more of that traditional background, plus Joe's experience on the regulatory side. Kevin, who does a lot of work engaging with states and on the federal level on legislation. And then Tom, really understands, federal agencies and things on a deep level, given his background in government. And so, yeah, you have this is the group here. And Joe, if you wouldn't mind in leading into the next slide, which Representative Ammon, if you can switch. There we go.
Yeah, very happy to. So as Melinda mentioned, we're going to kick things off just providing a little bit of background on Anchorage. Again, goal here is just for the benefit of the group to understand who we are and why we're talking to you today, and then we'll get into some of the other topics. So Anchorage Digital, at the highest level, we are a global digital assets platform. We were founded in 2017. In fact, as a state trust bank, we started out of South Dakota. And when I say we're a global digital assets platform, what that really means is that we provide custodial services, trading services, settlement services, and some what we would think of as crypto native services, things like staking, to institutional clients specifically across a wide range of jurisdictions. Most notably, and perhaps most relevant to the discussion today, is in 2021, we became the first crypto native institution in the United States to be granted a federal banking charter. We became a national trust bank. We're actually about a week or so away from our 5-year anniversary in this space. And why we'd like to start there is that it's an important, perhaps bellwether for how we've approached the ecosystem, not just in the US, but globally. When we were founded by security engineers, and this concept of security first became very critical to how we not just approach what we do as a company, but how we approach the ecosystem writ large. And the problem, really the goal of what our co-founders were trying to do was essentially obviate what was a longstanding dichotomy in the digital asset space. It was this idea that you have to trade off security with utility, meaning that you can have a very secure asset, right? The sort of proverbial, bearing a treasure chest in your backyard, highly secure, but effectively useless, right? It is very hard to use that asset and use it safely. And so we, as a firm, were founded around this idea of removing that trade-off with a particular focus on institutional clients. And in developing what for us is a quite novel technology stack around security, we wrapped a financial services business and then a regulated business around all of that, and eventually resulting in a quite integrated platform. So atop our what is now our federal bank charter, we provide other services through affiliates and through other regulated entities globally. We have multiple trading venues, both domestically. We have a BIT license out of the state of New York for New York clients. We have other trading services onshore. We have principal trading services, and we also support other jurisdictions like Asia Pacific through a major payments institution out of Singapore. So we really view ourselves as a global firm. And our goal here is to really integrate these services so that as we work with clients, we work with banks, we work with states, we work with sovereigns, we can bring to bear everything that we do in the digital asset side of things, but embed that into the traditional ecosystem as well. So with all of that and that brief introduction, I'm going to hand it over to Melinda to talk about Genius Momentum, and look forward to keep it moving.
Perfect. Yeah, so as everyone knows here, the Genius Act really was a huge unlock for us with regards to the stable coin business. It provided the regulatory clarity that could then action on the platform that Joe just described. And so we very quickly saw after that release movement from some very high profile clients. So highlighting three of them here to just give you a sense of what type of activity we're seeing since then. So the first one for us, we partnered with Athena, which is one of the largest existing stable coins, to help them bring their stable coin under the remit of for the U.S. And so that was our first major announcement, and then followed quickly by Tether, which is the largest company in crypto, the largest stable coin existing. We helped them basically with, we've partnered to help them bring that stable coin onshore. So we are going to have USAT, which is the US version of USDT, and this is really a new moment for the industry to be able to onshore these types of products that had been existing purely offshore previously. The one that I think is most interesting and relevant for the group here is actually Western Union, which was just announced quite recently. We've partnered with Western Union to launch their new stablecoin USDPT. Now, I think one thing that's important from this is it shows that, while Athena and Tether are very much crypto native companies that are issuing stablecoins, Western Union is clearly a traditional institution, but also one that you are seeing a company that has existed for 175 years and is now taking this leap to launch their own stable coin and seeing the value from this. So like New Hampshire, Western Union has a long history of leadership and courage to be first movers with new technology. So as a company that has been innovating with payments infrastructure since the 1850s, with one of its earliest achievements being the establishment of the first transcontinental telegraph line, we see this as continuity and really a blessing that they see the tangible benefits for the services that they provide to their clients. So what was now, with stablecoin remittances that are going to be modernized using the stablecoin that they're offering, we see this as validation of the future that the future of payments is going to be programmable, real-time, and interoperable. I think one, for the group, they have decided to launch their stablecoin on Solana. Anchorage is providing the issuance platform, so it's a white label stablecoin issuance platform. And I think it is due to launch in the first half of this year now, which we'll see where that goes. But there has been, a lot of discussion about how impactful it is to partner this technology with a extensive distribution network. So we're going to be talking a lot about banks as time goes by, but what comes to mind for me is when you think of empowering the distribution network that Western Union has, how that can apply to a network of banks, for example, in a state that have those local touch points, and how this can, this can be a technology that really provides enhanced services, but it requires that combination. So I will switch now to the next slide, if you wouldn't mind, Representative Ammon. Perfect. So, we are seeing, as I mentioned, we're seeing strong activity both from the crypto native side, from the traditional side, and now increasingly government as well. And so one of the areas in this that clearly New Hampshire has really been leading with reserve legislation and other innovation with the municipal backed conduit, the Bitcoin backed conduit bond that was issued to help fund the strategic reserve. This is an area that we are seeing legislation pick up and a lot more innovation on this side. Modernizing payments. We've had several states that have authorized the use of digital assets to be used for tax collection and other fees, and legitimizing that the assets for payments. But one of the areas that I think is most interesting and timely right now is actually the efficiency and accountability side of things. So, do you have a question? Yeah.
Which states are doing the revenue collection?
The revenue collection, I'll need to get back to you on specifically which ones there. I'm thinking, in my mind, what I'm thinking of is Louisiana has passed some legislation. Pennsylvania has passed some, but I'll need to confirm exactly, where that is. I'll come back to you on that. But there was recently an announcement actually from the Marshall Islands that I think has a very, that hasn't been discussed thus far in this commission, and I thought would have an interesting implications for the group. So the ability to use stable coins and other tokenized assets in order to ensure that payments are actually going to places that government wants them to go, and to efficiently distribute payments to citizens is something that we talk about in theory, but now with the Marshall Islands, you're seeing that in practice. So the announcement that was made was that they will be using a tokenized sovereign bond called USDM1 in order to streamline direct payments to citizens. And this serves as an example of how governments can use stablecoins and other tokenized assets to drive greater efficiency. The first point is, this is a country that has to deal with cash and the logistics of moving cash across, oceans and a lot of different logistics involved in order to get it to their citizens. So by incorporating the tokenized version of the bonds, they are eliminating the logistical hurdles that they have in terms of that physical cash distribution, and are able to get access citizens even in the most remote areas with both speed and then also the transparency. I see a parallel in this with servicing rural communities. I myself live in a rural community and have experienced the challenges of having to go to a bank and to do various things, and how that can be difficult. So I think when we think of incorporating this type of technology in order to really create efficiency and enhance the experience of constituents in rural communities, I think is one aspect of this example. The second is that the discussion, traditional stablecoins, privately issued or business issued stablecoins, have been garnering a lot of the attention in the media thus far. Even the partnerships that I was discussing fall into that bucket. But Marshall Islands opted to use a tokenized sovereign bond for their distribution, and it offers two benefits. One, it offers that quick payment. The transparency, the auditability of what we think of with traditional stablecoins. But because it's the tokenized sovereign bond, it can also work as an investment vehicle for the citizens that receive that. So I think this just lends to, there is a lot of, there's a lot that can be done in viewing what the optimal vehicle will be to actually suit a certain use case. So in this one, they wanted those two features, and the tokenized sovereign bond worked. And so I think there's a lot of customization and creativity that can be used in order to optimize a solution for a particular problem that you're looking to solve. So those were the two pieces that I wanted to bring up there. And I think that ties now, as we start talking about banking, into Joe, if you want to follow up with what you're seeing on the banking side.
Absolutely. Thank you, Melinda. So a number of these areas we've already touched on. As I mentioned in my introduction, the perspective and background I come with is really servicing the regulated financial institution space. And this has certainly evolved over the last, certainly the years I've been at Anchorage and the time I've been in the space, but really picked up quite aggressively over the last 18 months to 2 years. And when we think about how, we'll call it banking is not just changing, adapting, but also sort of actively innovating with respect to the digital asset space, there's a couple of key themes we've seen, which we have on the slide here. Two of them that are rather interrelated and closely tied to the concept of stablecoins or sort of so-called tokenized deposits are really around remittances and what you can think of as instant payments or settlements. Remittances is perhaps one of the longest standing and most classic use cases for stablecoins. The value here being basically a traceability and speed. As well as over time, and I can't say we have seen an enormous amount of this yet, but it is certainly one of the North Star goals is the concept of programmable transactions. Why remittances tend to be a really important part of the sort of stablecoin adoption story is because of the time and cost today associated with doing this on traditional rails. Very common to see multi-day settlement timelines, at times expensive wire fees if you're doing wiring, or in really any traditional money transmitter, particularly doing cross-border payments, right? The fees associated with the transaction as a percentage of the overall value. Some of that is related to managing foreign exchange currency risk, right? If I'm going from dollars to pesos, the longer that time goes on, the longer the volatility may actually change that price. And so, speed as a function of reducing FX risk and ultimately counterparty and settlement risk is a big piece of this. When we see this in the banking space, remittances certainly applies to the banks that have a remittance business or are actively participating in this. But the other side of that coin, certainly no pun intended, is the idea of instant payments here, where we have stable coins or other tokenized assets being used as a means of interbank settlement. Think the sort of Zelle concept, but on a stable coin basis. You can do this at the sort of institutional settlement level between banks. You could do this down to a peer-to-peer level. And again, the same features, right? The ability to do this very quickly, to be able to have a shared ledger among all participants in a settlement network to validate transactions, again, reduces time and eventually reduce costs both for the institution operating it and ideally to the consumers leveraging these projects or products over time. Where I think things start to get perhaps a little bit more esoteric, but also drive different types of value creation for both the sort of companies and institutions operating these products, but also the consumers leveraging them, is when we talk about digital assets as an asset class unto themselves, not just as a technology layer. And this is where things like collateralized lending and wealth management come into play. Lending, really credit extension, generally speaking, we can think of as one of the important pillars of the economy in the US. When you have a new asset class emerge, particularly, the easiest example here is Bitcoin, something that's been around for close to 2 decades now. Individuals have accrued this right over time, whether early adopters, whether through trading on an exchange. But they now have this. They now have this thing, right? This asset that has some value associated with it. And in the case of something like Bitcoin in particular is a good example. Over the last 5-10 years, the value has increased dramatically. If you want to utilize that asset for anything, you essentially, without a lending model or a credit extension model, you really only have one option, which is to sell that. And selling that obviously comes with important tax consequences. So when you're starting to think through how do we broaden credit access, one way is to broaden the assets that can be posted as collateral to extend that credit. And Bitcoin's a great example of this. So we have seen a pretty substantial growth both in active projects at the large bank and GSIB level, many active discussions at the community bank level, and even extending into other fintechs as a means of collateralizing assets like Bitcoin today, and eventually tokenized assets. So, digital forms of things like securities, equities, private credit, and so forth. This idea of collateral mobility as a way to broaden credit access is quite important. It's good for consumers. They don't have to take on tax implications. They can, add assets to their portfolio to get a loan. And it's also good for financial institutions because now they have a broader array of credit services that can drive, organic growth for their own businesses. Wealth management is do I hear a question?
Nope. Please continue, Joe.
All right. Sorry. Might have just been an echo on the audio. And I'll touch on wealth management as another variation on this theme. Again, if you think of digital assets in the sort of asset class side of things, the point, largely speaking, of wealth management is to drive wealth accrual, right? Whether that's an individual doing this out of a robo-advisor, to a person or family or a household doing this out of a local RIA or a state wealth management arm private bank, or a bank wealth management arm or private bank. The idea here is how can I responsibly gain exposure to another asset class as part of my broader investment portfolio. We've seen this develop over many decades, right? It's not always, investments in equities. It can be commodities like gold. It can be private credit for certain client types. It can be alternative assets. And you have, banks and custodians and execution venues that specialize in each of these assets. What we're seeing quite a lot of interest and, frankly, adoption in the wealth management space is actively enabling financial advisors to allow their clients to seek this exposure and do so in a way that drives growth to the advisor, but also provides the sort of safety and security to the end investor to say, I'm going to manage this actively in concert with the rest of my financial services portfolio. And I'm going to do so with a regulated firm, whether it's regulated at the state level or it's an SEC registered investment advisor. There are certain, supervisory obligations, consumer protections that come with that. And so as we've seen greater acceptance of this asset class, we've seen greater interest in the sort of regulated wealth management space for adoption. Why I touch on all of these, it really kind of moves into the next slide if we want to move to the next one, which is to say, how do we take these trends we are seeing, what Melinda touched on at the stablecoin level and the state level, what we're seeing in the banking space among our constituents, and sort of fold that into a story for New Hampshire. I think one of the things, speaking from some personal experience, that is quite interesting. A lot of the major innovation for even institutions such as Anchorage really started at the state level. I touched on at the beginning, we ourselves began as a state chartered trust company in South Dakota. That was not accidental. There were some unique carve-outs in South Dakota UCC rules that made that a favorable location for us to start our business. At the same time, we saw states like Wyoming, I would say, preemptively develop not just a licensing framework, but an entire examination manual specifically associated with overseeing the special purpose depositories that they wanted to attract to their state. I was actually part of a team that helped write some of that examination manual. And as far as I'm aware, it still remains the only papered examination manual specific to a state digital asset entity in the country. So when we think about how can we empower this, right? One very foundational way to do that is to develop a framework around this, and develop a framework for financial institutions to build and support the products and services here that ultimately drive things like capital efficiency for clients, whether that's through stablecoin usage, whether that's through credit extension or tokenization. The particular use cases really need to be client dependent, meaning what are my if I'm a bank, what do my end clients actually drive value from? Same with payments, right? Do I have banks who engage in remittance activity? Do I have clients who support peer-to-peer payments? And how can this technology or asset class support growth within my business and value to my constituents? Again, it is hard for any financial institution to do this without a supportive but also thoughtful supervisory framework around this. And the last one I want to touch on here, we sort of refer to as white whale opportunities. I think this is the important North Star that certainly many of us at Anchorage and many of our partners in the ecosystem, as well as the states and federal partners that we work with, have to keep in mind. These are the big ticket items. These are the future states of what really the technology is meant to unlock, recognizing that those take years and years and years of work to materialize. And so having these sort of white whale concepts in place is a good bellwether when you're sort of taking the incremental steps forward that drive near to medium term value. My favorite example for this, I give it all the time, is I will have confidence that the idea of digital assets, right, the concept of digital assets as a technology has truly been embedded in the financial ecosystem in a value forward way. When the next time I get a mortgage and buy a house, I don't have to physically go to the Norfolk County Registry of Deeds, where I live in Massachusetts, and pay a lawyer to do a lien search for several $1,000s in my property, because that property itself will, as part of the local and state ecosystem, have come into the blockchain technology. The history of those property records are embedded, they are immutable, and they are agreed upon on effectively a globally distributed ledger. There's years of work to get to that stage, but some of the first steps are: do we understand as a state the novel risks that the technology introduces? And further, how are we providing guidance to the institutions that want to engage in these assets, safeguards, and oversight? And with that, we'll move into the last slide, because we want to make sure that we do have appropriate time for Q&A. To me, that is what really drives this concept of responsible innovation. How do we take these ideas and either as a state work intrastate and work with the federal government on responsibly enabling innovation? Number one here has always been the concept of regulatory frameworks. Kevin mentioned work that's going on at the federal level as it pertains to clarity. An important part of clarity is how state registered banks can participate as custodians within the new clarity ecosystem. There's a lot of very high level requirements a state registered bank would need to meet to be a custodian in this space. A lot falls on the states themselves to operationalize the specifics of those requirements, provide not just clear standards, but clear investment training and oversight to, say, the state banking commission to actually enforce those standards in an innovation forward way. So I think establishing regulatory frameworks that work for the states and work for the opportunities the states want to foster is really critical. Very closely following that is, when you think about these frameworks and you think about what those standards do, how do you embed compliance into the design of the services that you are actually supporting? This doesn't mean the state itself mandating technology requirements, but the standards that your either state departments are going to embed within their own, say, RFPs or vendor contracts, but also within the expectations you would put on your financial institutions. A good example of this is we at Anchorage took security as maybe one of the most critical elements that support compliance. And so we think of as embedding security into everything that we do at Anchorage as a way of embedding compliance into the design of our financial products. With that certainly comes transparency and auditability, right? The ability to look through transactions, leverage what is actually one of the great benefits of blockchain as a general technology, which is it is not in fact anonymous. It's what we call pseudonymous, right? You can actually track transaction history back what we think of as many, many hops, right? You have real-time visibility, real-time confirmation. So there are tools that you can leverage for auditability that do not exist for, say, loose cash, right? Classic, loose cash being the, best example for say money laundering. This is something that blockchain as a technology is actually able to leverage to actively combat those types of activities. And stablecoins themselves are quite well known for being able to freeze, hundreds and hundreds of millions of dollars because of the traceability of transactions on chain. And all of this comes with this idea of landing with an integrated technology control framework. One of the questions we often get, whether we're talking to banks or state or local governments, is how do we think about consumer protection? How do we think about fraud? How do we think about money laundering? How do we think about sanctions compliance? The reality is that all of those obligations still exist and the risks still exist. What is changing here when you introduce a new technology or asset class is the means of controlling those risks and leveraging the different components of the technology to basically mitigate and manage. So if you're thinking about opening up or if you're thinking about allowing, say, a local bank to open up the ability to buy and sell Bitcoin to retail consumers, the same consumer protections need to be in place as if you were allowing them to buy any equity or any other product. How you embed that service provision, how you allow that data, how you ensure diligence on whether somebody's using a third-party technology vendor or building it themselves is really the critical element in all of this. We, again, have a very security-focused view of this, and we're focused on things like the bearer nature of something like Bitcoin. And so our version of mitigating that risk is authorizing intent. If you're dealing with a real-world asset, say tokenized equity, those risks are different because assets that are tokenized can be frozen, they can be reissued. And so you have to calibrate your technology controls and your risk management to not just the technology, but the asset that lives on that technology layer. So with all of that, I will pause right there. I know we're coming up more or less on time for Q&A. Maybe Melinda, I'll hand it back to you in person.
Yeah, no, thank you very much. Perfect. Yeah, so we want to, the next slide is basically, we'd love to open it up to Q&A if there are any questions. And also, everyone in this group, as a reminder, Kevin Wasaki is also able to speak to more the regulatory side if that's of interest. But we would love to continue the conversation and be helpful in any way that we might be. Yeah.
Questions? Jim?
Hi, Jim Kish here. Great job, Melinda. I have a question for either or both Melinda and Joe. Nice to see you again, Joe. So I talked to a banker this week in Texas who has a big remittance business. And so they're adopted stablecoin in order to make it possible. One of the things that was interesting in their conversation is that I always thought about this as, okay, so there's a remittance, there's a coin minted, there's a coin burned, and then there's an exchange for pesos, and you have the market risk that you spoke to. But what they're seeing is a trend is where the stable coin is just being held in a wallet. And I just wanted to see if from what you're seeing, are you seeing that trend as well from your observations? And the reason being, the reason I think it's interesting is that, then we have many participants that are part of the banking system, particularly if those are now tokenized and held in U.S. banks, and that those stable coins now can be used for more, kind of more basic needs. They're using that medium exchange instead of cash. So that I think that was the kind of the interesting observation. I wanted to get your perspective.
So if I understand this correctly,
Yeah,
yeah. Oh, Joe, yeah, this plays into something we were talking about, right? If you please take it away, Joe.
Yeah, I'll start, and then I actually want to hat tip to Kevin, because there's I think some interesting, what you're seeing play out is sort of an interesting part of the history of Genius itself. One of the we'll call it expected benefits over time of greater adoption of stablecoins is actually essentially a means of exporting and increasing the hegemony of the US dollar globally.
Big time.
When you, and this is actually why the remittance space is maybe one of the leading areas for adoption in stablecoins, right? Exactly what you're seeing play out. The idea that if I'm moving dollars, essentially US dollars, to a foreign country, and rather than those being, sort of immediately sold or burned to the local currency, they're actually staying within that. We're actually broadening access to the US Treasury market. Why that works is because stablecoins themselves, again, maybe they're starting as a remittance tool, but as they increasingly become used for, say, local payments through merchants, through card scheme setups, through local banks, it becomes easier and easier to just use that dollar and not pay the FX fee necessarily associated with requiring it to move into your sort of last mile local currency. So I would say that it's a very interesting, maybe early version of that playing out. But I don't know, Kevin, if you'd like to add to that from a policy standpoint.
Yeah, I think with the Genius Act, they use the term payment stablecoin for a reason. I think they really envisioned these coins being used, whether it's around the world, whether it's domestically for payments, because they're backed one-to-one. There's a lot of trust. There would be innovations that allow these to be used without, like at least on the front end, nothing really changing within the app you're probably already familiar with. For example, have a friend in Cameroon, recently moved back there from the United States. The banking system's underdeveloped there. He keeps his money in stable coins, right? And he can transact sometimes in stable coins. Sometimes he moves it into the local currency, but a lot of times he keeps it in stable coins. And again, like to Joe's first point here, I think Congress really understood the benefits of moving forward with the Genius Act in terms of exporting US dollars around the world. There's demand for stable currencies. The US dollar is the most stable among the fiats, and there's a lot of demand for it. So it's something that I think a lot of people on both the left and the right realize that it's very beneficial to the United States and all the people that use the US dollar around the world.
It's very interesting. I mean, that's definitely what's happening. If I had pesos and, or dollars, I'd probably stick with the dollars, right?
Right.
So
This is maybe like a little bit removed from that, but at the banking department, we license money transmitters. And one of the things, I think it's just a natural extension of this, like you use your whatever your chosen money transmitter is to pay for something like Venmo. And we see a lot of consumers just leaving their dollars on it, right? And not transferring them out of Venmo and just keeping them there. Now there's concerns about that. There's pluses and minuses to that, but I think the stable coin is just like the next layer back from that. There's a huge money transmitter market to other countries, and I think they frequently just leave them sitting there as dollars, US dollars now, but stablecoin is just the next iteration of that, I think.
Yeah, no, that's a great point. I think too is it's one of those exercises where if you build the markets, you kind of can see where the consumers are how they're gonna use it, and I think being for us and for the banking community, this moment of observation and just see, kind of where consumers where humans find certainty and security, and we can lower vulnerability. So I think it's a really good opportunity for the state and for the world.
There's one, and this plays into something, Joe, that we were talking about. There's another, I guess the inverse of that situation is if you think of a bank eventually one day accepting stable coins, the programmability and an ease with which you can convert at that point, there's also no guarantee that domestically, for example, someone deposits a stable coin into your bank, that you need to keep it in that stable coin, right? It could be something which is automatically stable coin received and converted into cash or converted into a tokenized deposit. So the similar to the way I deposit cash into, you know, my brokerage account, it can get swept into an FDIC insured account. You can execute these types of arrangements. So I'm not promoting any single one, but I'm just saying that in theory, you can set up an arrangement where you say, look, for a bank, we will accept deposits in stable coins. They just automatically get converted into what is the most optimal way so that you get FDIC insurance because they're tokenized deposits or things along those lines. And that creates a lot of flexibility, again, to go back to what's the optimal vehicle for the actual activity that is being done. Is it the actual payment, or is it buying and holding it, having it deposited in a bank, or investing it? You know, these you can easily migrate between different forms in order to optimize for the best consumer protection at that moment.
It's also frictionless to create an account. It's just an app on your smartphone, and the next person just has to download an app and you can interchange.
Yeah.
I won't go into this, but one of our banks, I had a lot of friction trying to create an account, and I told them about stablecoins. So I'll talk to Ryan about that. I had a question about fungibility of these tokens. So I noticed you in your slide here, I rewound to it, that you have a USA version of Tether. And I think Tether's something like the 18th largest purchaser of treasuries at this point. It's like on the scale
I
of a country.
heard 20, but it could
It's-
very
it's
well
in
be
there.
17 or 18 by now.
Are you
yeah.
going to have a North Korea version of Tether as well as a USA version of Tether? Like, why do we have our own special USA version of Tether when it's supposed to be globally fungible? So could you explain what's happening behind the scenes there?
Yeah, you know, Kevin, I'm not sure if you have a
happy
view
to
on.
take that
Yeah,
one.
yeah.
Yeah, so with Genius, it sets high standards for issuance of stablecoins in the United States. It does allow potentially foreign stablecoins in the United States too, but it limits those. And there'd have to be some reciprocity agreements between international jurisdictions to make that happen. So there's a strong incentive for any international stablecoin player to partner with an issuer in the United States or become an issuer in the United States itself prior to Genius going into effect, which is probably around January of 2027. So what we're doing with Tether is we're issuing a whole new stablecoin, and it's going to be Genius compliant. And the main differences I would say between like USAT and USDT, DT is the one that already exists and is out there worldwide, is the reserve composition is a little bit different. USAT, which again hasn't been issued yet, but will be later this year, that has to meet really strict requirements about one-to-one backing of cash equivalents. So think of maybe some demand deposits, short-term treasuries, money markets, things like that. I think USDT has a little bit more diversity, a lot of treasuries backing it, but also some other different types of reserve assets. So that's one of the biggest differences. But also the bill requires a number of other things as well, dealing with like national security matters, BSA/AML, things like that. So that's the reason why you might see in some instances a coin that's made for the United States, and then a coin that's kind of similar to it, but also outside the United States.
And are they swappable, bridgeable, fungible?
I mean,
I think that's
they're tradable.
Go ahead,
They're
sorry.
tradable, and there's slight differences of how the peg. So Tether, for example, has a certain spread, but they're for practical purposes 1-for-1. So it's tradable, but I wouldn't say that they're swappable. That's my understanding. Kevin, let me know if
Okay.
you.
I mean, I can dig into it later, but that's a curious thing that's
Mm-hmm.
stuck out. All right, I think we're a little over time. Any final questions?
I did, but.
Okay, you guys. Sure.
Well, thank you. My question is about the states versus national endorsement under Genius. And so maybe we have a similar question, or we'll ask it in tandem. But my question basically was, what are the features of a state that would encourage an issuer to select that state?
What are the features of a state?
So how
Or-
can
Yeah.
we?
or-
know,
I was kind of on the same
Yeah.
line. So Seth did a presentation a couple meetings ago, and one of the options that we have as a state is we could license or charter, companies that are under $1 billion. So what benefits or like, how do you see that market developing? Or I don't know if you're kind of on the same
exactly.
line.
No,
but
no,
it's like,
exactly.
yeah.
Why would a bank that wants to work with these encourage its clients, or why would an issuer? Because you can choose the national pathway or a state pathway, and then you have 50 states that are, some of which are opening pathways. What are the features that you would look for if you were selecting a state as opposed to the national pathway? What would be the features of a state that would make them attractive?
Because you guys started as a state charter, but now you're, on the
Yeah.
national charter. So like now that Genius has happened, is there any benefits to that state anymore?
I have an idea for this, though. Feel free, Joe and Kevin, if
Yeah.
you bring that up in. I think it goes back to what the utility of the stable coin would be. So if I am looking to issue that stable coin, and I'm thinking about the utility, that goes back to some of the things that Joe was talking about of what can you actually do with that stable coin within the state. So I'm thinking if I'm going to go to a state, I'm probably more focused on use cases that are applicable to those constituents. Is it possible to would the state allow me again to pay for things, pay my taxes and things in that stable coin? If I were specifically looking to grow in that industry, I would be looking for all of those ancillary use cases that it just increases the utility of that stablecoin, because the trade-off, of course, is going, and I understand Kevin's world of the regulation, but if it's substantially similar, you have limitations. But if you have a cap on the amount that you can issue, I think you have to lean into utility and the ability to experiment in a responsible way with where that sits. That's my thought on this. But Kevin and Joe, please feel free to add in if you have any other thoughts on that.
No, I think maybe Melinda, just continuing along your line. I do also want to draw maybe just a little bit of a step back on our own journey, from a state trust to a national predated, right, Genius and certainly predated Clarity, which hasn't passed yet by many, many years. When we look at state versus federal paths, certainly in the time, I was actually an advisor of Anchorage at the time we went down the federal charter path. That was actually focused as much on, we'll call it clarity for our clients in a world where there wasn't clarity generally at the state or the federal level, right? So that path we took, sort of ex stablecoins, was okay. By becoming a national bank, we would be what we think of as a black letter qualified custodian, and a very large constituent client base of ours are, say, SEC registered firms, right? Another feature, again, as a trust company, was bankruptcy protections, right? Bankruptcy protections at the federal level were quite clear, less clear depending on your state. And so when we think about, any firm choosing a state versus a federal path, it is, what are we trying to achieve within that, and what do our clients need? I think when we kind of come down back to the stablecoin question in particular, Melinda's I think dead on this, right? What is that state level issuance seeking to achieve? How are they using the token? What incentives are they building around the use of that token, right? The idea that a financial institution could decide to accept any number of stable coins, but then proactively convert those stables into their own issued token for use within a particular ecosystem, use as, I'm spitballing for the moment, but let's say it's a local community lender. They decide to lend out not dollars, but stable tokens, because those tokens can be used within an ecosystem of services or preferred partners that gives them some benefit. Yes, there's still a natural cap because of the $10 billion limit, but you can start to get sort of creative, again, depending on what you're trying to do locally, right? The biggest difference, of course, is the scale.
I think that's what Wyoming is trying to do. They're encouraging inter and intrastate commerce, and then the benefit will accrue as a public benefit. I think it's gonna go to the school system and other public benefits. So
Right.
that's kind of interesting. And because they're a sovereign, they might not have to be limited by that $10 billion cap. So that's like TBD down the road. Anything else final?
You know, one thing I was thinking about with an advantage that a state may have too is if a state had some detailed rules of the road, like you know that institutions and other crypto providers, you know, if they knew with a lot of certainty what the rule book was. I just think do you see that as an advantage?
I think that goes right back to Western Union. You know, when you have heard of Western Union in the crypto space before this, before I joined Anchorage, I'd done some work with Stellar, for example, and there was a lot of, you know, Western Union was, I apologize, actually, I think it was MoneyGram. So I apologize,
Okay.
just confused that. But basically, you have had these remittance platforms and platforms like Western Union and MoneyGram wanting to get involved and experimenting in a much more subdued experimental way, but not really embracing it. The fact that you have the passing of Genius Act and then suddenly, you know, the real announcements come and the real building that is, you know, really moving forward suggests to me that there was a lot of pent up demand to actually experiment and move forward in this, but it was highly limited due to that regulatory clarity. So to the extent that you do provide that full, you know, that true blessing to experiment, of course, within whatever rules, I think that you will see a lot more, you know, pick up and movement forward. I think there's just, you know, having come and worked at a regulated investment bank for many years, the number one message that I take from that is when you are with a large, you're a large company, you're an institution, no one risk is worth risking. Like no one business opportunity is worth risking the house, right? You're that big. You have to be highly conservative when it comes to risk. And so regulatory clarity is the number one risk that I think has been holding the industry back. So to the extent that a state within its state ecosystem can provide that kind of clarity, I think you will both attract those that want to be first movers, like New Hampshire, you know, is that willingness to, you know, to move forward and lead in these things. You're going to attract like-minded parties, and I think that they will, you know, start to actually take steps that you will start to actually unearth the benefits from consumers. So one of the challenges I would imagine your banks face is if you have stable coins, they're not coming to a bank and saying, hey, what can I do with this, right? So you don't know what you don't know. That's the constituents aren't actually bringing those to you to be able to say, we have so much demand, we're not doing it. The minute you have some steps forward, you're going to start to see people come and say, oh, I know you do this, but can you accommodate this as well? And then you really have the beginnings of a business plan and understanding of what those opportunities would be to really serve constituents better. That's fine.
Thanks, Melinda.
All right, so we're going to wrap it there. And Melinda, you're sticking around after
Sure.
the meeting, so
Yeah.
we'll have time for more questions.
Sounds great.
So we have 45 minutes left. We're going to move now to Charlie Utchel. Could you pronounce your last name, Charlie? Did I get it right? Ushil. Okay, Charlie. I have your slides up on the screen. We're going to give you 30 minutes. Does that sound okay to you?
That's fine.
All right. And then, you know, we can always continue the conversation later. Just a little background. We had BitGo, which is a friendly competitor or a peer to Anchorage, lined up, but they had their IPO 2 days ago or yesterday. So they're in their quiet period. So we're going to have them after their quiet period is over, I think in March, if that works for everybody. And so I saw this email exchange between Charlie and I think the state treasurer And Charlie, I don't know a whole lot about your project. I looked over your slides. The short version is you have an SEC registered stable coin, which I think is a novel thing. And I'll just hand it over to you. You just say next slide when you're ready, and I'll advance the slides. So take it away.
Oh, that'd be great. Thank you very much. And first of all, to the Anchorage team, phenomenal presentation. And I know what they went through to get themselves registered, chartered, everything like that. So that was really a phenomenal presentation. And we kind of did the same type of battle, but we did it almost taking our stable coin directly to the SEC probably about 6 years ago. And that's where we ended up today. But anyways, let me get into this. So good morning, Chair Ammon and the whole Stablecoin Commission. I want to thank you for inviting us to share insights today on these stablecoin models. And again, I think we are a good match coming after what Anchorage just delivered there. A little background of me. I'm originally from New England, spent many winters up at Waterville Valley and Loon. Went on to go to the United States Military Academy, went on to serve in the U.S. Army Rangers. Today, I am the co-founder and CIO for Series Coin. At Series, we've created a platform and an ecosystem centered around a securities-based, yield-bearing stablecoin, specifically tailored for federal and state government-managed financial and benefit programs. You know, our program or our approach emphasizes compliance, security, and efficiency. And today we're here to give you just an overview of what we've done. So next slide, please. There we go. So since April of 2025, we've had the opportunity to engage with probably about 20 state treasurers, departments, auditors, DHS services, all across the country, from Mississippi to Delaware, Connecticut, Maryland, Kansas, Missouri, Alabama, Wyoming, North Dakota. Gosh, I feel like Johnny Cash singing everywhere. Discussing how a securities-based yield-generating stablecoin can serve as a real-time auditable distribution mechanism to mitigate concerns around waste, fraud, and abuse. So our first meeting was in Mississippi, where we signed a letter of intent with the state treasurer there to explore integrating our product into their state's managed financial benefits programs like 529, SNAP, ABLE, and to expand even beyond that into FEMA programs and beyond, where he saw the tool that we had and how it could be used. We even assisted in crafting their legal opinion, which we hope to see actually come through in the next week or so, where the state treasurer will be actually allowed to hold and invest in a stablecoin. So the crisscrossing engagements taught us, a lot about what was going on. Solutions that addressed, we thought once we saw what was going on in Mississippi, that it would be the same for all the other states. Gosh, we were sorely mistaken with that. So solutions that addressed Mississippi's needs didn't apply in Delaware. Connecticut's issues differed from those in Maryland and in Kansas. In Wyoming, we actually have collaborated with the Wyoming Stablecoin Commission on how we can integrate our specific solution to what they've created with their Frontier token. We try to do the same in North Dakota, and right now in North Dakota with their Rough Rider coin, they're saying, hey, let us work through with that, and we'll be good. So what are my key takeaways from this whole crisscrossing across the country? We learned as much from the states as they learned from us. No doubt about that. The fact that I never knew what ABLE was. I never knew what the nightmare of unclaimed property was. And it was very interesting to hear the state's different pain points from that. So I learned quite a bit from them. Majority of states knew about crypto. Some did not. Some had no interest in learning it. So those conversations weren't as productive and not nearly as fun. But for the most part, when we did talk to states about stable coins, they assumed those stable coins are pretty much limited to the Genius Act's definition of a payment stablecoin. And gosh, Anchorage did a phenomenal job describing and showing all the different payment stablecoins there are, from Athena, Tether, Western Union. All of those are payment stablecoins in compliance with the recently released with the definition of what a payment stablecoin is. But what most states don't know, and what they don't focus on, and what we are, is part of the definition. Actually, it's the definition of what is not a payment stablecoin. And what a payment stablecoin is not, and what is excluded from that definition, is a 40 Act security regulated by the SEC. And that's what we are. So with that, next slide, please. Again, stable coins as we know them today, and Anchorage did a phenomenal job. I'm not really going to touch on the crypto stable coins. They did a phenomenal job for you defining what a payment stable coin is, giving you numbers of examples and how they're utilized. And again, defined in the Genius Act and then codified in the recent text issued as part of the Digital Asset Clarity Act, which they expect to vote on, I think, tomorrow. But it codified the rules around those payment stablecoins. Next slide, please. And all these models were largely built to replicate, again, or accelerate the payment rails. They are a useful form of commerce and settlement, but they were not designed to serve as treasury or cash management or for public sector financial stewardship. And that's where we fit in. And that's where this new third form has been developed, launched, and designed, not just for payments, not just for remittances, but for cash management. And then particularly where yield, oversight, and capital preservation matter, which is very important to the states. Next slide, please. So what is a security-backed yield-bearing stablecoin? It's designed to function just like digital cash, except we use regulated money market funds. Our coin represents a share of a U.S. government money market fund. Stability and yield now don't come from markets, but they come from the underlying securities, not from issuer promises or market reflexivity, but really from the underlying securities that are backing them. So in effect, this model tokenizes familiar short-term capital markets that you guys are all familiar with into a programmable digital transferable form. So you get a stable coin type asset, but it's ready-made for the government type usage that you would need it for. Next slide. So again, awesome job today. I'm not going to touch on what the payment stable coins are, because Anchorage described that to you perfectly. But I will go over to the far right column that gets into the security-backed yield-bearing stablecoin. What is backing them? Regulated securities, all governed by Rule 2A7. Here's the other neat part is, so all those stable coins that they showed you, Tether, Athena, Western Union, the yield all goes to the issuer. The people who hold the coins do not get the yield. They're not entitled to the yield. They're not allowed to get the yield. The Genius Act prohibits the coin issuer from delivering that yield to the coin holder. Not only can we deliver the yield to the coin holder, we have to. It's what's part of the coin. Our coin establishes a creditor relationship between the coin holder, and the assets held. So we have to give yield. The way they described in the Genius Act with the payment stable coins, there was a hat tip to the banks there. They're not permitted to give yield. We have to. So again, it's a security instrument, it's capital market aligned, and it's digital cash plus a yield that you guys are entitled to. Next slide, please. So what's really neat is when we first started this out and we would describe this to different people, as we were working on our use cases, people would say, Charlie, are you a tokenized money market fund? Are you a stable coin? And it was so hard for me to understand. I'm like, they're the same thing. To me, they were the same thing. And it was such an epiphany after about the I don't know, 10th conversation that I had, that people looked at a tokenized money market fund and a stable coin as two separate things, whereas we had always put them together, where we have this yield-bearing instrument that could keep a $1 NAV at all times and still permit the ability to do instantaneous peer-to-peer transfers of that value while still earning a yield. So that's what we can do. We are the best of both worlds. While you hold the coin, you're earning yield, and yet we can still do the same instantaneous transfers. We can track and trace all the transactions down to the penny and produce instantaneous auditability for the states. So as you look to manage how distributions are made, we can track them for you. Next slide, please. So that should have said Rule 2A7 compliance up there. We were rushing to get this in. So again, Rule 2A7 came out of the financial crisis, back in 2008, when Standard Chartered's money market fund broke the buck. So they put very stringent restrictions on what a U.S. government money market fund could invest in and how it would basically try to eliminate that chance of ever breaking the buck again. And what a perfect type of instrument to back a stablecoin with. And that's what we did. By the way, this was not an easy process to get through the SEC. We initially got this through under a Regulation A exemption. And normally that should have taken us 60 days to get it through. We almost hit that 60-day mark. It took us 2 years, 3 months, and 11 days to get it through the SEC, with 9 months spent on the GAAP accounting treatment of these stable coins. When our first user of our stable coin said, hey, we do about 600 million in transactions, you can only issue 20 million coins. That was one of the concessions that we had to make to the SEC. He said, how are you going to get this unlimited supply of coins? I said, watch this next trick. We're going to register our coin as a U.S. government money market fund. We're going to serve as the transfer agent for the money market fund. We're going to put the ledger for the fund on our blockchain. And again, as the sub-transfer or the transfer agent for it, we maintain that ledger. So that facilitates the instantaneous peer-to-peer transfer of value. We're not a money transmitter. We're not a money service business. All we are is a transmitter, a transfer agent that transfers value. So this enables the coin holder to benefit from holding the coin, earning the yield, and probably the most secure type of investment that you can have. Even better than, I would say, kind of a bank, whereas bank could be subject to runs, and that's why they have the FDIC insurance. What keeps our treasury secure is, one, they're U.S. government securities. And again, the 2A7 rules, the short-term requirements of what types of securities we're allowed to invest in, ensures that $1 NAV is kept in and that you're going to get your principal back. Next slide, please. So again, is this a bank deposit? Nope. Our coin holders own a share of a U.S. government money market fund. Is it cryptocurrency? Well, we maintain our ledger on a curated blockchain ledger. Right now, it is on a private chain. We are bringing it to a permissionless chain. We're doing this step by step, and we have to do it in accordance with what SEC requires from us. In fact, we have to report to them, or we will be reporting to them as we move our coin onto the Solana network, which is our next move with that. So again, we describe where the yield comes from, U.S. government securities, all based on that 2A7 rules. And does this replace your existing treasury systems? Nope. We're just a catalyst or I think a better use case for it in some cases. Just an extension. Next slide, please. Again, what makes and then here's where it really, I think, becomes very interesting what our stable coin can do. And one of the first use cases that we worked for and how we built this was as a transfer mechanism for the cannabis industry. So for people who know the cannabis industry, the ability to track and have seed to sale tracking on a transaction. We built our platform to be able to do that seed to sale tracking and reporting, where if someone used our coin as a transfer mechanism to purchase a cannabis product from a licensed dispensary, we could track that transaction down to the penny, down to the batch number, lot number, SKU number for that transaction. And then once we realized how we figured out how to perfect that in that industry, we just took it to the next level. If you need to track transactions and know where they're going, that they're going to the right person at the right time for the right thing, we're the system to do it. And all the while, you're holding the yield still on these coins. So again, we've looked at doing it for different types of programs. In the States, we're right now talking to the ABLE programs, public benefits assistance programs such as SNAP, Sunbucks, all different types of use cases we can do for the state, all while the state still earns the yield. Next slide, please. Yeah, and this goes back to that whole concept as we went to those 20 plus state departments, auditors, treasurers. We've built a phenomenal tool. And again, as I went in those meetings thinking that, oh, I know what all the state's pain points were, I learned right away that every state was different. So we have a great tool for you. You now determine where is the best place and how to utilize it. Next slide, please. Again, we've talked about how we did this. It's a tokenized representation of a share of the M360 on-chain U.S. government money market fund, Rule 2A7 compliant. It's multi-patented. We have patents around the technology that we built, going from tokenizing or a patent on this type of stable coin to how using blockchain for a digital signature to guarantee a transfer, to tying in a stable coin to a supply chain management system. We have 4 patents on that. Next slide, please. Yeah, and this was former Governor Phil Bryant was the one who brought us down to Mississippi. Just kind of his take on what we built with this. And with that, I think next slide. I'm happy to take now questions. I think I got through that really quickly. I will ask that question that was asked at the end of the Anchorage question about why an issuer would come to a state. Please ask me that question.
Feel free to answer it.
We
Save some
set
time.
our stable coin up 100% to do this.
Why don't you answer that question now? Go ahead.
So phrase the question again, exactly how you did it.
Well, I think I was asking why. So given that under Genius, you can choose a federal pathway or a state pathway, why would an issuer choose a state pathway, and why a particular state? What would be the features within that state, whether that be how the state set up its law or its regulatory apparatus, or I think what we heard earlier, its network and its other ways to utilize and operationalize the token? What would make a state appealing as the situs of your registration?
We flipped that around based on how we did this system by going to the highest level. And we went and hugged and held on to the SEC right from the start with this. And gosh, when the SEC actually even fought us on whether this stable coin was indeed a security, we had to answer about 500 or 600 comments. But by going to the federal level and getting them almost to get this thing registered and acknowledged as, all right, you are a digital asset that's capable of peer-to-peer transfers. Now we have created a tool so we don't have to choose the state then chooses us. And again, it goes back to my statement that every state's problems are different. I'll bring up the state of Kansas had a grant program where they were matching 529 distributions with taxpayer funds to people who took their 529 out, and as long as they used the 529 money for an approved transaction, the state of Kansas had a grant program that they'd match that. Well, there's one abuse of the system in that some of the grant money or the 529 money was used to buy things that weren't allowed by the 529 program. And then the treasurer would only find out about it a year later when an audit happened. It required 2,000 hours of audit to figure out what was allowed and what wasn't. That it became a program that was not manageable and actually was going to be forced to sunset. What we allowed him to do is say, hey, now when they still can run this program, but we can do a real-time audit of the transaction when that transfer happens. We're able to whitelist transfers. So we can permit that audit time to go to zero. We're a self-auditing tool, and we can whitelist it for them. So now you go to the state treasurers or state governments or the state agencies and say, hey, where are your pain points here? So in some states dealing with like Sunbucks. Sunbucks is an offshoot of the SNAP program, where the government provides, it's $120 per low-income student during the summer months when they're not in school, so they can eat. There's about 13 states that opted out of that program. Federal dollars coming in, and they opted out because one, the admin costs associated with, they had to pick up 50% of the admin costs, and it was very difficult to audit and manage. And we have approached some of these states now and said, hey, we can run your Sunbucks program. And in fact, one of the neat things that we talk about doing is those Sunbucks dollars would come into the state. We put it in, it would be in the state's coffers now, and then we would issue a derivative of our coin, because we actually have to do a derivative of it, where it still functions on the same rails, but the state's now earning yields on that federal dollars that are going to the state beneficiaries. And we track and trace all the transactions on non-yielding coins, but they're all held up at the state government, at the state level, earning yields. So whatever the program is that you want done, we can do for you. That's why I say we're a great tool. So one thing that we've talked to why the Wyoming Stablecoin Commission about, and Treasurer Meyer, they have issued Frontier Token, and Frontier Token again is governed by state law. They passed a state law to issue it, state regulations, and I forget what the state law that it was issued under. But whoever holds Frontier Token, the yield goes to the state of Wyoming, and the state of Wyoming is using that yield to pay for their education costs and things like that. We said that we're happy that they want to still use their Frontier Token. They can use it for payments. They don't care what the payments are done for, but we had talked about, all right, we don't care about that. You can put your Frontier Token on our rails, and we can now track the transactions. We'll onboard the people, since we already have to do that as part of our transfer agent requirements. We can track and trace those transactions down to the penny.
All right. Question on your rails. Is it an open permissionless blockchain that you're using? You mentioned Solana. Was it in the future potentially? What are
Correct. We are yes. We are right now built on Hyperledger Fabric, and actually we chose Hyperledger Fabric early on in this process because just we understood, knowing how the SEC was looking at handling this and how we would handle all BSA and AML KYC requirements. I felt most comfortable on a permission network. As SEC has got more comfortable with us, and we've got more comfortable on how we can maintain those KYC AML requirements, we are now migrating over to Solana, and that should be happening in Q1 2026.
All right, validate this comment that I'm about to make, because it sounds like there could potentially be a big idea here. Half of our state budget comes from federal dollars that we pay in federal taxes, and it comes back to us. If the state tokenized that, significant amount of money, the state could issue tokens down the stream and potentially capture yield on those funds, and not just this year, but in perpetuity, accumulating over time. Is that potentially an opportunity? I know it's kind of a far out scenario, but it's kind of what I'm hearing you describe. If you could just tell me where I'm wrong.
Would you like to join my sales team and take this to the other states right now?
But is that that's a pretty big idea if that's what you're describing there.
We would like, at Ceres, we would like to run the entire SNAP program for the state, for the federal government. And when the money would come from USDA down to the Department of Health Services at the state level, so I don't know what New Hampshire's take is on that. I should know that, but I don't. But if New Hampshire was getting $1 billion every year from food stamp program, we could set this up that money would come from USDA to the DHS at New Hampshire. You would start earning yield on that. We would strip out the yield to the SNAP, New Hampshire-based SNAP tokens. We would do all the onboarding of the SNAP participants. We would do all the onboarding of the SNAP vendors, and we would have a fully transparent, auditable system of how SNAP benefits were being utilized throughout the whole ecosystem. So not only are you getting rid of waste, fraud, and abuse, you're now earning yield on a federal payment system until they're, again, once they are exercised or redeemed for cash, they are redeemed, but it doesn't matter. For that little period of time, you're earning yield.
Okay, so they
100%.
when they're redeemed, then the
is
yield
how we
goes to
envision
the
going with the states.
when they're redeemed, the yield accrues to whoever is redeeming them, the end user.
If or if only if they didn't, some people say, hey, I don't want to hold on to Ceres coin or whatever we call this coin. By the way, that's something that's really neat with this. We have built a system. We have built a platform. If you wanted to call this New Hampshire coin, you could. We would be your plumbing for it. So Frontier Token is very specific to that. They built their own token. So if you wanted to use Frontier Token, they'd be happy to let you use it, but they'd be earning the yield when you were holding the coin, when you'd be holding the Frontier tokens. They get to keep that. So, and that's the biggest differentiation here. When you talk about USAT, when you talk about Athena, when you talk about the Western Union coin, all those issuers are keeping the yield. We are not. And that's why we're a great tool for the state governments.
All right, interesting. Any other questions? I think we're just about time.
Okay.
Jim, go ahead.
Just one question. How do you think about and how do you manage liquidity risk inside of your network?
So liquidity risk with the treasuries?
Yeah, just given movement of large dollars and redeeming large dollars between public entities, I'd imagine there's got to be some stress on liquidity.
So one way we mitigate that risk is by being a U.S. government money market fund. And in fact, the Securities and Exchange Commission and U.S. government spent a lot of time on that coming out of the financial crisis. And actually, if you go down on the slide in the appendix, it gets into a little bit on this 2A7. Keep going. One more down.
That was
So
2A7.
this gets into your.
Oh, I'm sorry.
Go up.
There's a delay. It's my. I'm not pausing. There you go.
Okay, sorry about. Yeah, very important for you guys, the state, to understand what it means with this Rule 2A7 compliance. This is what we're buying with these securities, the most liquid securities that you can probably have in your account and what's back in yours. So even if every coin was instantaneously redeemed, we would have the liquidity to give your even value back.
So I don't know how familiar you are with the PDIP pool, the public deposit investment pool, but that's what they do. It's just, it's that exactly. So this is just like the stablecoin version of the PDIP. Like this is like if you wanted to make the PDIP a stablecoin, you would do what this guy's doing.
Yeah, well, that seems like a parallel for sure.
Yeah, yeah. That's
Sure.
that was all I could think when I was
Yeah,
listening to his
and I-
presentation.
And how do you, how do you ensure that there's, so you have controls in place to make sure that you're always, everything that flows in, you have collateral and that's all audited and you can demonstrate. So who's your,
Charlie, that was for you. I think.
yeah, do you have an outside auditor that takes a look at this periodically?
Yes, we do.
Okay,
Yeah, they're
Yes,
required
we're
to have
required
one.
to do.
Okay. got it.
Tate Weller is the auditor for this fund. And actually, series, we have, not bore you with this, but we have also our own investment token called Series Token. Because we issued this under Reg A, we maintain a PCOAB audit on how our operations work. So we go through, we have annual and semi-annual reports that we have to do with an audited report every year. But this fund is audited. The fund itself is audited by Tate Weller.
All right.
The
Question?
custodian for this fund too is Huntington National Bank. That was an incredibly difficult process for us when we tokenized this money market fund. Trying to find a custodian. There were custodians that were comfortable doing a tokenized money market fund. When we put as part of our disclosure that one of our use cases was going to be as a payment system and almost kind of a banking system for the cannabis industry, I got a lot of polite declines to be your custodian. Huntington finally agreed to it once. It was a long it's about a 9-month process to find a custodian for this. And now we have other custodians asking to, hey, could we now join in with this? Now they saw it could work.
All right. More questions? We're good. Anybody online? Dan, I see you on there. Andy and Katie. Any questions by you guys? Sorry, I didn't engage you more.
Nothing for me, Keith, but thank you.
Okay.
Nothing for me either.
All right, great. All right, so we'll wrap up here in about 5 minutes. Thank you, Charlie, for doing this on such short notice, and I think you've introduced like a whole new concept to our group here. So thank you for doing that.
That's my pleasure.
All right, very good. So I had a little bit of time for just member reflections. If you want to discuss anything as a group here, future of this commission. I still want to solicit alternative viewpoints, and I'm having a little bit difficulty finding skeptics of this. So we have a balanced view. We're supposed to touch on environmental factors, which kind of got introduced to the bill. I guess my take on this, if it's not a proof of work coin, then there's really not a lot of energy use. It's more just computation. So, but if you have suggestions for me, and members of the public, if you're listening, if you want to make suggestions, please reach out. Yeah. So just feel free.
along those lines, I think it was the guy, I forget his name. He came to one of our earlier meetings. He talked about maybe doing a presentation showing that proof of stake and the power usage compared to what Bitcoin would take for the mining. So I don't know because most of these are all proof of stake.
Yeah. So stable tokens and real world asset tokenization has to be on a smart contract enabled network, and Bitcoin's really not that. So, but yeah, if you have.
But I thought he was going to do it was like your cell phone takes more power than what it would take. Like he was going to do, I forget his name. He came to one of the earlier meetings.
Okay, I'm not recalling. But
from UNH.
was it Seth? He's from UNH.
No, it wasn't Seth.
Carter.
Yeah, yeah.
Okay.
Interoperability lab guy.
Yeah,
Interoperability.
he was talking about maybe just showing that as a
Okay.
What, just to make sure if people had concerns about the energy costs, that what
They could see it.
They could see it.
Okay.
I don't know. I don't want to put him on the spot, but like that
Yeah.
was one of the conversations.
I can reach
but-
out to him and see
Yeah.
if he has a slide or something he can give us.
Yeah, I still have some lingering questions around what are the state's capacities to build out some of the infrastructure that would be required to be a state issuer? Because we heard a presentation today, like Cirrus, which is, hey, this is a bundled solution where, you know, what they're offering is a whole different regulatory pathway, but one that doesn't require a big build out from the state. So I think a key question remains, what's the state's capacity to invest in the type of infrastructure is needed to become I mean, are these alternatives realistic, I guess, given where the state's at financially and with capabilities?
So I don't know, just to go back to talk about series, it struck me when I was listening to that. I was like, so take the public deposit investment pool. That's what I was talking about earlier, that basically does this, but without the stable coin part of it. It's not under my jurisdiction anymore. So you'd have to ask Monica Mezzapelli, the state treasurer who runs it now. But I would imagine a company like this, so it's run, she has to hire by statute, do an RFP, get bids to have an investment manager run that pool. I would imagine, I don't want to put words in anyone's mouth or ideas, you would have to talk to Monica, but I would imagine that these guys, for example, could just plop in and run that pool without like a lot of infrastructure changes. Please don't hate me, Bankers Association, because I know we have issues with, it's a very political thing, the public deposit investment pool. But I'd imagine something like that could be done without much change to infrastructure. From what I'm hearing in this presentation, this is the first time I'm hearing this. So I think it really depends probably on what like you'd have to talk to like the Department of Revenue, the treasurer, that sort of thing for a lot of this. Because there's probably programs where you could just plop this on top of it and it wouldn't take much.
Sure, what's popping up there?
But to kind of go back with Seth though, if we are talking about like HHS and other agencies that aren't here, like is there a learning curve of crypto? There's going to be, it'll take them a lot longer. So that's back to kind of the point is like, sounds like it's easy for us to do it. Is this other state agencies ready to utilize it? Because, you know, they can, if they get a grant, look how easy it would be to manage a grant after this, you know, or Homeland Security, if they're giving stuff to, after a disaster to different towns, like that was a lean project we did when I was at safety. We'd have to like figure out efficiencies and all that stuff and how much money's left on the table. Like that's what's the state ready to do if we could do it, because the technologies, it's all there. I mean,
You know, I'll just I'll be George Bailey for just a moment. And the deposits we have in our bank are in home mortgages for people. Sometimes they don't qualify by normal means. And so if we take sizable amount of dollars and move them to the federal government because they're going to be held in securities, we're just taking the money from the state and moving it where it can't be reinvested. So we just have to consider that. And I would say with modern rails, and some of the things we heard from Anchorage is that there's a lot of organizations that have gone down this path already for us that we could adopt them. We're pretty close to a turnkey. You know, while Siri seems attractive, it'd be really scary to think about us having a capture where money is being captured and held in government-backed securities.
the thing we were talking about is like, instead of refinancing your mortgage, you just tokenize with a bank.
Right.
And then you don't have to pay all those other, like there could be a new way of getting money into New Hampshire banks. If they're, you know, or, you know, because they could tokenize your mortgages that are held by companies outside the state.
Definitely.
And that's the, you know,
Yeah.
bringing those real world
Yeah,
equity
definitely.
back in.
Yeah, definitely. It's one of the considerations as we move from education into the design phase is to look at, you know, how do we maximize the benefit at this kind of inflection point. There's a lot of different things to think about.
And like I will say that the issue that you brought up vis-a-vis the PDIP is the exact issue that you guys have with the PDIP, whether it's tokenized or stablecoined or not. Like that's the same issue that you're up against now, I think. So I
Yeah,
think it's really
It's
interesting.
better
really-
now because we're actually participating
a
now,
different-
and where it was
Yeah.
U.S. Bank in Minnesota. Well, and I was born in Minnesota, so it was good. The money went to
Yeah.
the place where I was born, but that just doesn't
Yeah.
good use here.
Yeah, I think
So-
it's really program dependent. So you'd almost have to pick a program,
Yeah.
whatever program it is.
Like a pilot.
Yeah,
Yeah.
you just got to pick something, you know?
But I mean, do we all agree that if we do nothing and we keep it the way it is, that we're going to get left behind? I mean,
Amen.
yeah. So
Yes.
And that's back to like the question Seth had that I was kind of piggybacking on. I think some of the other things too, if it's the fees and the chartering and all the requirements of like these smaller companies, if we were going to do some of those things, like what you're talking about, that gaps in between. So, but
all right, I have invited I added the DRA and the treasurer, the office of the treasurer to the distribution list. So at least, and they're welcome to come and sit with us if they want. You want to come up to the microphone and? Yeah, it's a official proceeding here, so got to do it the right way.
My name is Karen Tuckerville. I'm a resident of Kensington down the seacoast, and I own and operate a farm, but prior to that, spent my career in finance with a focus on institutional investing in the foreign exchange markets, derivatives, and eventually started my own registered investment advisor. Just explaining, why I'm here. I'm extremely interested in this topic for a whole variety of reasons. And I wouldn't say that I'm coming in to be a skeptic because the benefits seem really, really clear to me. But, with reward goes risk. So the greater the benefits, the greater the potential risks. And my career trajectory often involved taking a contrarian view of markets and thinking through different risk scenarios. So my hope in participating in this group is that somewhere down the line at the appropriate time, after I've absorbed enough information and insight from all these wonderful presentations, that maybe we can tease out some kind of risk scenarios and visualize what kind of regulatory frameworks might minimize those risks. Obviously, you're not going to get away from them completely, but how to be intelligent. And a lot of this may involve public education as well. And how they would utilize these tools, not just the state representatives and officers are obviously going to become very well informed in the process, but thinking about what the public education component might be as well. So anyway, just
Very good
thank you
points.
for letting us. I think this commission has been extremely well organized. I love seeing everything on the website. I think the discussions have been terrific, and I'm glad that I was able to participate.
Thank you. That's great points. Thank you. And continue to do so. We'd appreciate it. All right. Sir, would you just turn the mic on? Yeah.
Thank you. Woody Canterday, and I just wanted to ask, my background is consulting to financial institutions using market research, and I studied fixed income bond dealers for a long time with Greenwich Associates. And in retirement, I have a keen interest in monetary history, so I'm always interested in what the impact is going to be of technological changes and so forth. I teach a course on that for the adult learning programs at Colby Sawyer and Dartmouth. I just have a couple of questions. One is, because I have a keen interest in making sure that community banks, local merchants are well protected as these changes take place. As mentioned, the changes underway are massive and very, very strongly positive in a lot of ways. But I was thinking the same thought. They do come along with side issues that you can't always predict, and that's the kind of thing I tend to focus on as well. But on the, thinking on the positive side, one of the things I heard today and I wanted to ask about, I don't know if Joe is still here, or maybe Melissa, you can address this. I thought I'd heard that, or I imagined that a community bank with a stable coin could potentially make a loan to that stable coin and have it be ring fenced for payment to local contractors and so forth, so that the money would stay in the state, at least at the initial payment stage, after which, they could choose what to do with it, I suppose, at that point. But that could allow for the potential for a preferable rate for those borrowers, if you will. Was I hearing that correctly?
Make sure I understand this correctly. So one thing that my understanding currently under the regulations is that banks could not accept stable coins as deposits right now. That is something that could be included and accepted. But when you think about the concerns that you have about deposits, losing deposits that then can be reinvested, one of the concerns is if they're sitting in stable coins and they're backed 1-for-1, they can't be reallocated and lent out. If though you adjust that a bit and you say, well, we're actually accepting the stable coins as the deposits, and then the stable coins could be lent out, that creates that velocity. Or you say we accept stable coins and they're automatically converted into, let's say, tokenized deposits, and the deposits then are sitting in the purview and can be let out. Those could potentially provide alternatives that keep that that movement going within the bank. That is my understanding, and I am going to say this is going a little, I wouldn't say that I'm an expertise in this particular side of things. So, but in terms of, is that answering your question, or were you thinking of something a little bit?
It's dealing with the technical problem of the stablecoins not being lendable, if I understand correctly, or used by the bank as a way of providing funding to a borrower.
The collateral.
But
Right. So stable
Yeah.
coins themselves, or any tokenized asset, as long as the regs support it, can be used as collateral or lent out. Like stable coins, actually, if you think back, this is going a little bit of crypto history, right? The issues that you had in the last cycle, where with, let's say, Gemini Earn and Genesis, basically this was a situation where you had investors who were purchasing stable coins, or they were investing in stable coins. They were purchasing stable coins in order to generate yield. The source of that yield was not inherent to the stable coin. It was actually not the pass through of the yield associated with the collateral on the back. It was actually generated by just players lending those stable coins into the ecosystem. These were pure lending transactions. So now that the issues around that were separate, and require, that's an area where you can say, we have lots of precedents of how to protect and prevent those kinds of scenarios, again, in traditional markets. But I bring that up just to say, lending of stable coins has been part of the crypto ecosystem for years now, and is actually how a lot of the trading activity functions in the back end. So there's nothing prohibiting stable coins from being lent per se. It's more that if you're thinking of separating the collateral backing the stable coin from the actual token at that point, that's where regulation right now is in the middle, trying to decide. Does that answer your question?
yeah, I understand that. It was helpful to have the differentiation as well of the tokenized deposits, which then the bank could control maybe in some way if you have an ability to track those. Yeah.
Tokenized deposits are sitting under the exact regulatory framework. So.
Thank you.
We have some follow-up.
I was just thinking this is to add, maybe, we'll see. With the smart contracts is what a group of us bankers are looking at nationally, is it allows that programmability, provides just a whole lot of flexibility on how money's dispersed, under what conditions they're dispersed, and all the way through how we control a transaction. So it's just the beginning, with Genius Act, it's still kind of fresh. It's really got us thinking about things that we hadn't even conceived of before. So it's kind of interesting. I'd love to continue a conversation with you as things emerge.
Thank you.
The thing I was going to make a comment about deposits, though, and we've heard this a few times, like once you have it in your wallet and your phone, why are you going to use an institution? And that's going to be the bigger thing about where people keep their stable coins. So that's really the thing, is because if it's so convenient to have this, like, why would you need anyone else for that once you
Well,
get it?
competitor to demand deposits, you mean? It would substitute for demand deposits. Is the
Mm-hmm.
Right.
concern.
But yeah,
You'll
that's
go
what I'm saying.
you'll go where the yield is, right?
If there's no yield, or if there's no purpose to put it, it's like
Right.
you're going to keep it to the easiest way to use it. So if it's peer to peer is all you operate in, and that's all you're going to need it. If you need business to business, and that's kind of what
by
it is. So-
demand deposits, I meant typically very low interest or no interest being paid, right? So if the competitor is stablecoin and holding it there with the convenience of it, I can see why people would pull the money out of banks as a result of that. So
Yeah.
But there's a large group of population that doesn't use banks now, and they're not conditioned themselves to be in banks. It's their parents that get them in the accounts. Like you're seeing there's people that are not tied to that right now.
The
Yeah, it's
Venmo.
what I
And
was
if it
saying.
gets easier to use these products, they're going to use it less and less.
It was what he said earlier about the keeping it in the stable coin when it gets remitted to another country. It's that same issue that we have currently with money transmitters, where like if it's in a stable coin and they don't have any motivation to move it out,
yeah, I would think the motivation is much stronger overseas to leave it in dollars, right? Because of
it's
the
pretty strong here
staying
though. At
outside of
least.
the
You
But
do
it's-
see it here?
system.
Oh,
I'm just,
Oh yeah, if I don't have to pull money
100%.
on my account all the
Yeah.
time to give it to you, and I can just leave it on
And
my
we
phone.
can just leave it in the PayPal. I'm
Yeah.
using them as an example.
Yeah.
Yeah.
Anyone, name Western Union probably has this issue too. Any money transmitter, they like consumers these days, that's an issue, and it's there are concerns about that because it's
Yeah.
not
Oh,
FDIC
yeah.
insured.
Right,
You
it's
know, like
uninsured.
it's an interesting issue.
And it's been a while since we looked at numbers, but I think
Yeah.
we had like $1 billion
Oh.
leave the state of New Hampshire in crypto just in one quarter.
Yeah, and it just
With our
sits there.
consumers that we regulate.
Sorry, left in stablecoin crypto, you mean?
No, there's people in New
traditional
Hampshire
crypto.
that transmitted $1 billion in crypto out of the state in one quarter.
In 1 quarter.
In one quarter.
So that's just the beginning, right?
Well, this is last year's data. I mean,
Yeah,
that's
this is old.
These are the reports we get.
but I mean, that could accelerate and
Correct. If it's easier to use and I can use stablecoin at this business, or
Yeah.
my friend takes it, it's going to be
so
even more.
I guess, is there, if every New Hampshire community bank issued their own stable coin, I don't think that would have any use for anyone. But is there a way to pool collectively together and kind of have New Hampshire banks, cooperate as a block with that?
Or it's the give me the business. You probably already have the business where they make it seamless. Where if you give us this stable coin, we give you that stable coin that the next person wants. Like that, you're seeing the stablecoin exchanges companies starting to start up and stuff like that.
To
Go
make
ahead.
it
this goes to
seamless,
Jim's
yeah.
point about programmability, right?
Yeah.
You can set up, what is that? It's basically, automating operational processes to get that there. But what you're bringing up is someone who started her career at a bank in the middle of the financial crisis. That this is something that it's just so foreign to me. But I think it's also a differentiation. At Anchorage, we focus on institutions, and so what Joe was discussing about the reason why we went for the federal charter, that unambiguous qualified custodian status and full bankruptcy remote, that is something that is was a huge, in the whole time I've been in crypto at similar types of institutions, being bankruptcy remote and what happens in those, scenarios is just a part of normal due diligence for institutions and very important. But what you're talking about is that and this goes back to what the lady had mentioned about education. There is, it's not fully appreciated there. But then Joe, I don't think talked about this in the presentation, but it's something we can discuss in a follow-up is, a lot of the companies that he is working with specifically are doing B2B2C. So we have these best practices that the institutions are bringing on. And then there's a question of how do you extend that even further to the controls and things with consumers, and you could potentially explore saying, look, in these types of situations, what are the appropriate guidelines for companies doing this in New Hampshire to make sure that they are safeguarding. I think holding. You even had this with Starbucks, right?
Yeah.
They've turned into,
Starbucks cards?
Yeah.
All right, so we're over time, so I'm going to wrap it here. I did have identify areas for future examination or study, and one I think is the algorithmic form of stable token. We haven't really covered that, so I'll try to get somebody who's qualified to explain that to us. If you have ideas for topics or future direction, I know we got to land this plane eventually, but I think this is very interesting stuff. I think we're learning some good stuff. So with that, I'll call the meeting adjourned, and it's. So we're getting kicked out of this building because statutory study commissions are low on the totem pole. So if you don't mind, I'll work with you on getting some dates for. We're going to go to the banking department. They're kind enough to lend us a conference room. I think I'm going to send out like a survey to see what I'll get with you to see what dates are available, then send a survey out to figure out what dates next. So does that work? All right. With that, adjourn the meeting. Thank you. Thanks everybody online.